In 48 hours, gold went from printing an all-time high near 5,608 to trading down around 5,037, while the rules for holding that position quietly tightened underneath the market. Not months, not weeks. In 2 trading sessions. 19% on a risk-off day when gold still fell. They said the playbook was simple. Yields down, gold up, fear up, gold up. And yet the tape did something else entirely. It was about collateral. It was about how rates reprice at the open, how leverage gets remeasured, and how a small change in margin can force a large change in price. Institutions already understand this because they live inside the plumbing. Most people only see the headline chart. And when the plumbing shifts, the chart becomes the last thing that tells the truth. Here's the pattern interrupt. The most important moves in gold often happen when gold is not the main character. The main character is funding. The main character is the cost of carrying risk overnight. The main character is what happens at the open when the market has to translate yesterday's assumptions into today's requirements. Once you see that, the last few weeks stop looking like randomness and start looking like a mechanism. Welcome to Signal and Structure, where we decode what matters before it becomes a slogan on financial television. If you've ever wondered why a safe haven can drop on a day the world is nervous, you're in the right place. If you listen like a wise elder listens, you'll notice the quiet details that explain the loud moves. And if you want to be part of the community that reads the data instead of the drama, leave a comment with where you're watching from. Because the global map of this audience is one of the most honest indicators of what people are actually paying attention to. Now let's reconstruct what actually happened with forensic detail. Because the mechanism hides in timing. 35. That number matters not because it's a trophy, but because it changes behavior. When markets push into new highs, leverage tends to appear. Momentum funds press. Short hedges become uncomfortable. Options dealers adjust. And as the price rises, the notional exposure of every futures contract rises with it. The same number of contracts becomes a larger pile of risk simply because the price is higher. Then the reversal arrived, and with it came the part most people missed. The exchange raised margin requirements on precious metals, lifting the initial margin on gold. Futures from 6% to 8%, and raising heightened risk margins as well. Not long after, margins moved higher again, with gold's initial and maintenance requirement stepping up to around 9% from 8%. On paper, that sounds like a small adjustment. 1%? 2%. But margins are applied to a large notional base. They are demanded immediately. When you combine that with a fast move in price, you don't just change sentiment, you change who is allowed to be in the market. Imagine you were holding a stack of chairs on a moving truck. Yesterday, the rule was that you needed 1 strap for every 10 chairs. Today, the rule is 1 strap for every 7 chairs, and the road just got bumpier. You can keep the chairs, but you need more straps immediately, or you have to unload. That is what a margin hike is. It cares whether you can fund the position under today's rules. This is why you can see something that looks like a contradiction. The bond market can signal slowing growth and falling yields, which is normally supportive for gold. But if the gold market is simultaneously dealing with forced reductions in leverage, the selling pressure can overwhelm the macro relationship. And the timing matters because rates reprice at the open in a way that is brutally mechanical. Overnight, a new set of yields becomes the reference point for everything priced off funding. Repo levels shift, futures implied financing shifts. Option markets rehedge. If the open comes with a new rate regime and a new margin regime, the first hour can become a liquidation window, not a discovery window. To understand why this keeps happening, you need a historical lens. In 2008, gold did not simply rise because the world was scared. It first fell as leveraged players sold what they could to raise cash. That was the first move, sell the liquid stuff. Then, after the forced selling, gold began to express the longer-term narrative of monetary response. In 2011, the pattern repeated with a different costume. A surge into a peak, then a sharp collapse as risk limits tightened and positioning unwound, followed by a longer period where gold's role in the monetary conversation stayed alive even as price adjusted. And in 2020, the pattern became almost theatrical. During the initial shock, gold sold off with everything else for a brief window, even though the long-run case for gold was being strengthened in real time. The first move was liquidity. The second move was policy. The people who only understand the story in headlines get confused during the first move. The people who watch the mechanism recognize it as a transfer from forced sellers to well-funded buyers. So when you see gold whip around an all-time high and then drop sharply into a margin hike, it should ring a bell. It is the same playbook. Volatility spikes, risk managers raise thresholds, exchanges adjust margins, leverage compresses, and the market searches for a new equilibrium. The question is whether the market is in the first move or the second. Now, let's talk about the players, because mechanisms don't execute themselves. Start with the exchange and the clearing system. Futures are not like buying a coin and putting it in a drawer. Futures live inside a daily settlement process. If the price moves against you, variation margin is owed. If margin requirements increase, additional collateral is required. Clearing members must ensure their clients meet those demands. That means broker risk teams call. That means funds decide whether to wire cash, cut risk, or unwind. That means the market's opinion can be shaped by someone's ability to meet a deadline. Then add the dealers. Dealers are constantly managing inventory and risk. In a calm market, they provide liquidity and hedge their exposures. In a violent market, they become more defensive. Bid-ask spreads widen. Inventory limits shrink. Options hedging flows can amplify moves. If a lot of call options were bought into the rally, dealers might have been long delta and long gamma. As the market turns, hedging flips, and what was supportive becomes pressure. The move that felt like momentum on the way up can become mechanical on the way down. Now add the macro funds and systematic strategies. Many models treat gold as part of a risk or inflation basket. Some strategies scale exposure based on volatility. When volatility rises, they reduce exposure, regardless of fundamental conviction. That is another form of forced selling, but it is forced by rules, not fear. And it tends to show up at the open because that is when the models update, the orders get placed, and the liquidity is being tested. Then add central banks and official institutions, the slowest but most consequential buyers. Over the past year, official sector purchases remained elevated, with reported buying in the hundreds of tons. That flow is not momentum chasing, it is reserve management. It is a long-duration decision about what constitutes a neutral asset in a fractured world. And when a market is forced to liquidate, those slow buyers can absorb supply, but they do it at their pace. They don't care about the first hour of the open. They care about the next decade. This is where coordination appears without a meeting. No one has to conspire. The system coordinates through shared constraints. The exchange adjusts margins because volatility rose. Brokers tighten because their risk rose. Models de-risk because volatility rose. And suddenly, a market that looked deep becomes shallow. That is not a mystery. It is a synchronized response to a single input, higher variability in price. Now we arrive at the dislocation, the part that looks like two universes talking past each other. Universe 1 is the macro narrative. In that universe, falling yields and risk-off sentiment should support gold. Universe 2 is the collateral narrative. In that universe, a margin hike and a repricing of funding at the open can force selling in gold, even if the macro backdrop is supportive. You can see the dislocation in the way correlations break. You can see it when the dollar and gold move together, or when yields fall and gold falls, or when equity volatility rises and gold fails to respond. But it is only confusing if you insist on one story. This paper versus physical tension is often where people look for drama, so let's handle it with discipline. Futures prices reflect the marginal transaction under the rules of the exchange. Physical demand reflects a broader set of behaviors, including jewelry, industrial use, and long-term reserve accumulation. In periods of stress, the futures market can be driven by the need to post collateral, while physical demand remains steady or even increases. The result is a temporary gap between what the paper market is forced to do and what the physical market would choose to do. So when you see the price drop on a day that should have supported gold, the question becomes, who is being forced to act, and who is choosing to act? Forced actors sell at the open, voluntary actors buy later, and the entire move can be explained by the sequence of who has to move first. Now let's put the evidence on the table in a way that connects directly to price. First, the margin change. Going from 6% to 8% in initial margin is a 1/3 increase in required collateral. If a fund had allocated a fixed pool of cash to support a given number of contracts, that fund suddenly has to cut exposure or find new cash. If the next step takes margins from 8% to 9%, that is another jump. Each incremental increase reduces the maximum leverage that can be carried. The market doesn't need a new piece of news to sell, it needs a new constraint. Second, the rate repricing. If overnight yields move and funding markets adjust, the cost of carry changes. For leveraged players, a small change in financing can matter because it applies to large positions. More importantly, rate moves often coincide with risk sentiment shifts. On days when yields fall sharply, it can reflect a flight to safety, but it can also reflect growth concerns. Those concerns can trigger de-risking across portfolios, including selling profitable positions to meet liquidity needs elsewhere. In that environment, gold can be treated like a liquid asset, not a symbolic asset. Third, the institutional backdrop. Central banks have been adding gold at a pace far above historical norms, even if the pace moderates quarter to quarter. That matters because it creates a structural bid that is not sensitive to daily volatility. It is like a steady current under a choppy surface. When forced sellers appear, that current can eventually stabilize the market, but it does not prevent the initial turbulence. Fourth, the psychological marker of the all-time high. New highs attract leverage. They also attract late hedging. Corporate buyers, importers, and asset allocators who ignored the move may suddenly act. Options open interest can cluster around round numbers. When the price reverses, those clusters become magnets for hedging flows. This is not superstition. It is market microstructure. Now here's where it gets interesting, because the mechanism can be explained without turning this into a textbook. Think of the market as a series of doors that open and close based on collateral. When margins rise, some doors close. When rates reprice at the open, the hallway shifts. People who were comfortably inside a room suddenly find the door narrower. They can stay, but only if they can squeeze through with more cash. Those who cannot squeeze through have to step back, and when a lot of people step back at once, price moves fast. That is why margin hikes can look like attacks on a market, even when they are simply a risk response. The effect is real. The intent is mechanical, and the winners are not the ones who predicted the headline. The winners are the ones who can fund positions when the door narrows. To see how quickly this becomes real, translate the percentages into dollars. A standard gold futures contract controls 100 troy ounces. When gold was trading around $5,500 an ounce, that is roughly $550,000 of notional exposure per contract. Under a 6% initial margin, the collateral to hold that contract is about $33,000. Move that to 8%, and the required collateral becomes about $44,000. That is an $11,000 difference per contract, due immediately, not gradually, not politely. Now add daily variation margin. Futures are marked to market. If the price drops, the loss is settled in cash. That means a margin increase can land on top of a losing position, like asking for a higher deposit right after the value of the house just fell. In practice, the sequence is brutal. The market gaps lower, variation margin is owed, the broker asks for cash, and then the exchange asks for more initial margin on top. Even disciplined investors can become forced sellers when the cash timing is wrong. This also explains why the open matters so much. Overnight, price can move on fewer participants and lighter volume. When the regular session begins, the market has to reconcile the overnight move with risk limits, collateral schedules, and new information. If rates have repriced during the night, the entire curve of what constitutes a normal yield shifts. That shift changes how every risk manager models stress. The open becomes the moment when those models meet reality. It is not just a bell, it is a recalculation. And while the Western narrative focuses on futures, the global physical network keeps operating. Refiners, fabricators, jewelers, and reserve managers respond on different timelines. Sometimes that creates a geographic premium, where demand in one region stays firm even as paper prices fall in another. When those premiums widen, it is another signal that the futures move is being driven by funding stress rather than a sudden collapse in underlying demand. If you want the cleanest definition of the dislocation, it is this. The price is moving because the ability to hold the price exposure is changing. That is why you can watch gold fall on a day when fear rises, or fall on a day when yields fall. In those moments, the market is not voting on gold's meaning. The market is solving a balance sheet equation. So what does this mean going forward? Historically, when a market experiences a leverage squeeze tied to margin and funding, the path tends to follow one of three scenarios. In the conservative scenario, volatility settles, margins stop rising, and the market rebuilds liquidity. In that case, gold may resume trading more closely with macro variables like real yields and the dollar. The key is whether daily ranges compress and whether open interest stabilizes, signaling that forced selling has largely completed. In the moderate scenario, volatility remains elevated, and the market chops through a wide range as different time horizons fight for control. Forced sellers are intermittently replaced by opportunistic buyers, but each new spike in volatility triggers another wave of de-risking. In this scenario, the market becomes headline-driven, but the true driver remains positioning and funding. The indicators to watch are margin announcements, implied volatility, and the behavior of gold on days when yields move sharply. In the aggressive scenario, a broader funding event emerges. Perhaps a sudden tightening in collateral availability, perhaps a shock in another asset class that forces cross-market liquidation. In that case, gold can initially be sold as a source of liquidity, even as the long-run narrative becomes more supportive. The tell is correlation. When everything sells together for a brief period, it is usually liquidity. And when the dust settles, the assets with structural demand and policy tailwinds tend to reassert themselves. Notice what is missing from these scenarios. A promise? A guarantee. Markets do not owe anyone a clean story. They only reveal constraints. And right now the constraints are flashing through the behavior at the open. So what should be watched specifically if the goal is to understand whether the first move is ending and the second move is beginning? Watch margin changes. They are rare in calm periods and common in stress. Watch whether the exchange stops tightening. Watch the daily settlement behavior, especially whether large intraday drops reverse later in the session, which can signal that forced selling is being absorbed. Watch real yields, but do not worship them. If real yields fall and gold cannot rally, it is telling you something about funding pressure. And watch something most people ignore: the tone of liquidity. Are spreads wider? Are moves happening in thin hours? Are gaps appearing at the open? Those are signatures of a market negotiating its own ability to function under new rules. Now we arrive at the divide, and it is not about intelligence, it is about attention. Some people only watch the price and then search for a story that fits the candle. Others watch the mechanism first. They ask, who is being forced to act today? What rule changed? What constraint tightened? What market is repricing funding at the open? That difference becomes a gap. Not just a knowledge gap, but an outcomes gap. Institutions move first because they have the data and the plumbing. Retail moves last because retail is told a story after the move has happened. And the same cycle repeats: a sudden spike, a confusing reversal, an explanation that arrives too late, and then a new equilibrium that makes the earlier confusion look obvious in hindsight. This is why gold's move has a mechanism. It is not a mystical metal doing mystical things. It is a global collateral asset trading inside a system that constantly remeasures risk. When that measurement changes, price must change to match it. Rates reprice at the open, and gold is one of the places that repricing shows up most violently. Because gold is where leverage meets fear and funding meets narrative. So if the last 2 days felt like the market broke, understand what likely happened instead. The market tightened the rules, and the participants who couldn't meet the new rules had to adjust immediately. The selling was not a referendum on gold's long-term role. It was a response to short-term constraints. And those constraints are the real headlines, and once you see it, you cannot unsee it again. This is signal and structure, where we decode what matters before it becomes the headline everyone repeats. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether the mechanism will keep operating. The question is whether you can recognize it while it's still moving, before the story catches up.